Good evening and welcome to the Money Show, the show that puts your money matters front and center in a world full of financial noises. We are here to bring you clarity, confidence, control over your personal finance. I'm Kavita Thapliyal, and whether you're planning for retirement, building a portfolio, navigating debt, or just trying to make smarter money decisions, this is your space, your guide, and your check-in with your wallet. Every evening, we bring you insights from top financial experts, decode the latest trends, and answer your burning questions on saving, investing, spending, and everything in between. Because here on the Money Show, we believe one thing: you don't have to be a finance expert to take charge of your money. You just need the right advice. So let's dive right in. And on this show, we also do your life financial planning. So just in case you want to send across any question or your investment portfolio for which you need a check from our experts, do send across your queries on our WhatsApp number 865-797-4571, the money show at etnow.tv, and email ID where you can send across your queries as well. All right, let's begin the show, and a very interesting topic today for freelancers. Flexibility is a perk, but financial uncertainty is the price tag. With no fixed paycheck, at the end of the day, income can swing wildly. High one month, low the next, or sometimes nothing at all. This irregular cash flow can throw routine expenses off track, make investments inconsistent, and even create last-minute financial crisis. So how can freelancers strike the right balance between spending, saving, and investing? And what strategies can help them not just survive the lean months, but also build long-term wealth? Today, we explore practical, realistic investment approaches designed especially for those who live life beyond the 9-to-5 salary slip. I have with me Shilpa Gole, Principal Officer, Partner, Nerdy Bird Wealth Advisory LLP. Shilpa, good evening and welcome to the show. Okay, talking about freelancers, lots to be done. It's very case specific, like every other financial plan or investment strategy. But let's talk about volatile income, and with that, budgeting. Freelancers often have no fixed paycheck. How does the irregularity impact their ability to budget and plan expenses? What's the first step they should take to ensure that monthly commitments are met despite fluctuating income?
Kavita, thank you for having me on your show. And yes, like you rightly pointed out, freelancers have a big struggle with income. There is the irregularity, the uncertainty, the ebbs and flows. And in all of this, the big challenge is that the fixed expenses don't stop. So there are certain recurring expenses that you're making month on month, be it your house rent, be it your loan EMIs, your utility bills, your groceries. Those don't come to a stop. So what do you do then? And how do you meet that challenge? And I think if you look at the impact of not having a regular cash flow, I think the biggest impact is that in periods of lean income or no income at all, those are periods which are very stressful for freelancers. There is the emotional side to it, the stress that they encounter there. On the other side, there's also the fact that when they have to bridge that cash flow and they have to meet these expenses, very often they end up borrowing to meet the expenses. And when you're talking about personal expenses, they definitely resort to credit cards and personal loans, which are very high cost debt without really having knowing when your next income's coming in. So this is definitely the biggest struggle for freelancers. And just like there is flexibility in terms of the way they live and how they earn, they also need a lot of flexibility on the expenses, on the saving side and the investment side. I'll come to that shortly, but before that, let me answer the question around budgeting. For freelancers, I always invite them to think annually instead of thinking month on month like a salaried person. So here we're talking about all the expenses that you typically incur in a year. And be it your EMIs, be it your savings and investments, but all the cash outflows that you have in a year. Then I ask them to break it down as per seasonality, like put it down in a calendar and figure out what are those months where certain expenses have to be made. Let's say your school fees has to be paid or an insurance premium has to be paid out. Let's calendarize everything. That's one strategy that I find is very impactful with freelancers. The second is, once you've made this list of expenses and you know that there are certain recurring expenses to be made month on month, we sit down and figure out how this has to be paid out now, and how many months in a row do you typically have lean income or no income at all. So the moment we know that, let's say it's 3 months at a stretch, or let's say 6 months at a stretch, we figure out an income buffer fund, Kavita, and that would be the first step. It's similar to an emergency fund, but it's not an emergency fund. Emergencies are unplanned. Here we're talking about a buffer fund for planned expenses. So this totally depends on how many months you typically expect to go without income, or how well prepared you want to be for this lean season, and accordingly figure out what that budget is, and make sure that you have a fund set aside for that, Kavita.
All right. Uh, all right, so let's take this ahead to the next step, balancing expenses and savings as well as your investments. Now, how can freelancers create a structure that ensures routine expenses are covered while still saving and investing regularly? Is it realistic for them to set a fixed monthly investment amount, or should they opt for a flexible model just in case, the income is not consistent, which is seen in most of the cases? Like pandemic was a very bad time for all the freelancers. There was suddenly no money, and I mean, even the pending projects from which they were supposed to get the money, because usually what happens is there is a typical cycle in which they work. Freelancers, sometime after doing a project, they get money after 3 months, 6 months. Most of them do not get it immediately also. So even that cycle of payment had stopped. How do you deal with all this then?
So, superb question, Kavita. So, I think there are two parts to it. One is seasonality. So, there may be certain people who earn more in certain months and earn less in certain other months. And there's also the part about not getting your payments on time. So, delayed payments, your clients not paying up at all. So, how do you really prepare for that? In terms of routine expenses, we've spoken about it, have that income buffer in place for, let's say, 3 months at a stretch or 6 months at a stretch, whatever you're comfortable with. Now, when it comes to savings and investments, what I would invite freelancers to do is to think annually. So, a salaried person typically thinks, every month I need to do an SIP of X amount to reach my goal by, let's say, in 20 years' time. You still want to reach your goal in 20 years' time as a freelancer, except that you're now thinking annually. You're thinking about how much you want to contribute annually, so that you know that you have that flexibility and that wiggle room, that when there is money in abundance, those are the months where you make these investments. And I think there's a big myth about SIPs not having flexibility, or a lot of products not having that flexibility. So a lot of freelancers have told me, hey Shilpa, SIPs are only for salaried folk, right? Like it's a monthly thing that you have to do. Now that's where the cousin of an SIP, the STP, comes into the picture, a systematic transfer plan. So when freelancers get money, it comes in lump sums, it comes in big amounts. So at that point in time, the first thing they need to do is set aside some and refill their income buffer fund. So that is the first thing they need to do to make sure that that has been refilled. The second thing is make investments for their long-term goals, Kavita. And there, what they can start to do is park that money in a liquid fund and set up a systematic transfer plan. So that way, just like an SIP, they're going to get the benefit of rupee cost averaging. They don't have to worry about timing the market. In a staggered way, the money will move into equity, except that it's going to happen on a recurring basis at a certain point in every month. So you can decide that I want this STP to happen on, let's say, 10th or 25th of every month. So you set that up and make sure that this money then moves into the market systematically. And that way you're also able to take advantage of buying into the market at different points in the market cycle, Kavita.
All right. Let's talk about ideal investment strategies. Now, assuming that they get money in lump sum, which investment options are best suited for freelancers who may not have predictable cash flows? SIPs, lump sum, or they can opt for a mixed strategy. Should they focus more on liquidity or long-term growth? Also, emergency fund. This also becomes a very important aspect of their financial planning, because a chunk of money needs to go there. People with EMIs, people with home loans, people with kids who go to school, have their fees coming along. So how do you also plan your emergency, contingency, fund planning, and then rest of the financial goals?
Sure, Kavita. I think you very rightly pointed out that your first priority is liquidity. You want liquidity in your income buffer fund. At the same time, the income buffer fund is for planned expenses. It's for routine expenses that you have month on month. So in addition to that, you do want to have an emergency fund as well, which is for unplanned expenses, for the out-of-pocket hospitalization, for longer periods without income, for any unplanned expense that comes your way. Now, for both of these funds, the investment strategies are very similar. We're talking short term. So whenever you have funds available, flexibly start investing them into a debt fund, a liquid fund, a money market fund. These days, you also have fixed deposits that are flexible. So you have flexible recurring deposits that you can do, so that whenever you have the funds available, you can park them into a recurring deposit. So these are some strategies that people can use for their emergency fund and for their income buffer fund. And make sure that your emergency fund is also sizable. Make sure that you have at least 6 months of money in an emergency fund in addition to your income buffer fund. So definitely freelancers need a lot more liquidity. This is not going to beat the inflation for you. So the idea is to keep refilling it and topping it up to meet your purchasing power needs. On the long term side, I would say use the STP format to put your money into equity. Whenever you have lump sums, use STPs, set up STPs so that the money moves into the market in a staggered format. And in addition to that, for stability in your long-term investments, people always want a bit of a defensive strategy, putting money into some kind of debt as an asset class. There, I would say, look at Sukanya Samriddhi for your daughter, look at a public provident fund for other long-term goals, because these offer that stability. At the same time, though there is a upper cap on how much you can invest, there is a lot of flexibility and wiggle room within a year. So within a year, whenever you have the funds available, you can go ahead and park it in these investments. And last of all, Kavita, I'd like to talk about the national pension system. This is also a product which the government has designed beautifully. You don't have to do it through an SIP route. You have the flexibility to put in money into NPS whenever you have the funds available. And there's no upper cap there. So from a retirement standpoint, I would say NPS just helps you maintain that financial discipline. It does lock in your money, but I think for freelancers, that lock in is very important. You want something set aside for your retirement without you having to worry so much about it.
So also, Shilpa, what about parking your money in certain specific debt instruments which are low risk? Let's talk about products. Although equity can be used for long-term planning, but then emergency and parking your money in debt instruments, which one would you select? And also, do you have the freedom to select something which is as per the right scenario, for example, the rate cut scenario, or for you, liquidity is the first priority and that should be your concern rather than looking at gaining returns or looking at interest rates right now?
Looking at interest rates right now is definitely not something that I would say it'll have some marginal gains, but nothing more than that. So definitely, if you want to lock in higher rates, FD rates are going down. Your savings account is also not going to offer very much to you. So in such a case, you can look at short-term debt funds, Kavita, and for something that is medium term or let's say slightly more than like a year away, you can look at dynamic bond funds. You can look at funds which are investing your money in corporate bonds and government bonds. But do keep in mind that these do have a little risk associated with them. They're relatively more risky than putting your money into a liquid fund or an arbitrage fund or any other fund that puts your money in money market instruments. So I would say that for your income buffer fund and emergency fund, definitely look at money market instruments, any mutual fund that puts your money into money market instruments. Anything that's a little longer away than that, where you want the stability of debt investments, you can look at a variety of debt funds available that park your money in corporate bonds and government bonds. So do make sure to diversify along the way. And you could also look at investing up to 10% of your allocation in gold through gold ETFs and gold savings funds, Kavita.
All right, Shilpa, I think with that, it's time up on the show. But then, yes, you highlighted a very crucial aspect of financial planning. There's a lot more to discuss, but then that's the time I have for today. Thank you so much once again and helping our viewers with their financial portfolio and strategies.
Thank you.
Time for a quick break. Post that I'll be joined by Pankaj Matpal, but then I'm going to also slip into a break with our WhatsApp number and email ID that will be flashing on your screen. So do note it down and send across your queries.